According to a Motley Fool article, the Fed's recent interest rate increase by 75 basis points to stop inflation is not good for highly valued growth stocks like SoFi because they hurt the future earnings potential of a stocks.
Is that so?
But in his latest interview with CNBC, SoFi CEO Anthony Noto expressed the uncertainties and market volatility eventually drive the need for financial services up.
In periods of uncertainty and volatility, the need for financial services goes up.
How is that possible?
On the other hand, Mizuho Securities remains bullish on SoFi stock despite lowering its price target to $7 a share.
$7?
There was also an article from Investorsplace.com that suggests SoFi stock could make a comeback if its book value grows each quarter consistently. In today's video, we will go over some of the key factors that could potentially signal a SoFi stock comeback, find out what is currently happening within the business from SoFi CEO Anthony Noto himself, and find out why Mizuho Securities remains bullish on SoFi despite lowering their price target. If you're a SoFi long-term holder, watch until the end of this video. You don't want to miss any of this. Also, we're not financial advisors, and none of this is financial advice. So like always, do your own doo-doo. Also, if you want more of Wealth Gambit, you can find us on basically any social media platform at Wealth Gambit. Links will be in the description box below. Without further ado,
Let's get started, people.
according to Investorsplace.com, SoFi is likely to report a higher book value in its up-and-coming Q2 earnings calls. If SoFi's book value consistently increases every quarter, then it could be one of the catalysts for SoFi stock to bounce up, according to Investorsplace.com. For those of you that don't know what book value means, book value, according to Investopedia, is the value of a company after it has paid off all its debt in case of liquidation. Investorsplace.com states that at present, SoFi has a price to book value at 1.05x or even lower, depending on SoFi stock price, which unfortunately stays around $5 to $6 a share at the time of recording this. A price to book value ratio of 1, according to Investopedia, means that a company's market price is equal to its book value, which signals a good buy for value investors. Investorsplace suggests that a consistently growing book value and an increasing number of SoFi members will likely attract more SoFi investors. Another key factor that could potentially increase SoFi's book value is the demand for its financial products and services, which according to SoFi CEO Anthony Noto, remain consistent amidst the high interest market environment.
I'd say the demand for our products has stayed really consistent, and once people use our products, whether they're investing or they're spending with a credit card or spending through their checking savings account, it's remained consistent with what we've seen in the past. And the most important thing for us is to make sure we don't overextend ourselves in any way to capture too much of that demand. So we're looking at a vast amount of economic data to make sure that we're still green across the board.
If there wasn't consistent demand for SoFi products and services, that wouldn't be a good look for SoFi. And this is what Commander Noto is seeing in this highly volatile market.
It absolutely is. And our guidance back when we reported in May called for 50% year-over-year growth in revenue from $1 billion in 2021 to $1.5 billion and above that in 2022. And we are thriving in this environment, both because we're taking share from traditional banks, in addition to the fact that our members are doing more and more with us every day.
We've talked about this many times in previous videos. You hear it from Commander Noto himself. SoFi is taking huge market share from legacy banks. SoFi is building its business to be able to handle every single one of your financial needs in a one-stop shop, so there wouldn't be any need for most people to use traditional banks. Some stock market experts like Mizuho Securities, Dan Dolive, aka Dan DZ from the Streezy, remain bullish on SoFi as he sees SoFi as one of the most resilient companies.
100%, and I think that's what most people don't appreciate. It's got about a 740 average FICO loan for their borrowers. If you look in the past, recession cycle, right? So the high FICO, the super prime, has actually outperformed the lower prime. It's a lot of common sense. But I think people don't appreciate that those personal loan borrowers are, very high FICO, which is very different from all these other kind of names that people don't like right now. Plus, they lend deposits. They're like a bank. They are a bank, and that makes them more resilient. They get a better spread between the lending and the borrowing because they're a bank. So they got the best of both worlds in that sense.
Danny D expressed that he believes that SoFi will go up in the long run and that lowering their price target on SoFi stock is just marking it to market.
Hey, thanks. It's not a bank. It's not a fintech. It's say Fintech. This is kind of how we call it, right? So we took down the price target to 7. I just think it's enough upside here. I mean, we want to, I think long term there's definitely more potential, but we want to see it. We want to give it like a reasonable, given where multiples are. So that's just more of a marking it to market. But our call today is very, very simple. The valuation has actually gotten to a point where even conservative financial investors who didn't like SoFi because it screened as too expensive, they now see this as being, hey, reasonably priced. And you've got all the optionality of like high FICO lending, deposits, and all the things that they're actually like not priced in.
All of this news makes it seem like SoFi stock is in a good spot to bounce back. But
Is it really?
let's flash back to before SoFi announced its Q1 2022 earnings report last May. On May 9th, a day before SoFi announced its Q1 2022 earnings, Upstart, one of its peers in the fintech industry, announced its Q1 2022 earnings report, and unfortunately, Upstart's earnings call came in with some bad news. The company cut its revenue guidance for 2022, causing its stock to fall dramatically and eventually dragging other public fintech companies like SoFi, Lending Club, and Affirm along with it. As Danny D said, SoFi is one of the most resilient companies in the market today. It can strive in any market condition. One of the best ways to diversify, in our opinion, is if your investment diversifies its revenue streams, which SoFi does, but this isn't financial advice. This is shown in the consistent growth of its members, financial products, and more. But while SoFi, the company, is healthy as a business, one piece of bad news from one of its peers in the fintech industry can still drag its stock price down, so be careful when making short-term bets. SoFi's fundamentals aren't showing any signs of slowing down. On the contrary, they're actually looking like they're speeding up. And Danny D still believes in SoFi for the long term, and so do we. So to all the Sofian soldiers out there, shout out to all of you who showed support in our previous videos, and a special shout out to everyone in our Patreon community who truly helped to make these videos possible time and time again. If you want to join the community, the link for that will be in the description and the first pinned comment below. Shouts out to Arthur Magazu, Wei Chu, Daniel Corbett, Mr. Welfare, Casey Patel, Jeff Sherman, Gregory Villar, Bo Park, Denzel, Reginald Davis, Les Broadway, Christian Cardelphi, Kevin Beaufrond, Jay Bone, Daniel Zinson, and ABC Sam. You guys are real ones, and we appreciate it. Until next time, peace.